Hello YouTube, it's the accounting tutor again, and in today's video we're going to cover the question, what is a contingent liability? We're going to focus on defining it, but also exploring how we account for it, and also how we disclose it within the financial statements. So let's dive straight into it. In order to understand what a contingent liability is, we need to understand and go through the process of redefining a liability, understanding what a provision is, and then understanding what a contingent liability is. This is because a contingent liability is pretty much something that doesn't meet the criteria of a provision. So let's remind ourselves what the definition of a liability is. And remember, I've already covered in a separate video understanding in detail what a liability is, and the link for that video will be right above you now. Okay, so in brief, liabilities are defined as per the IASB revised conceptual framework, and they're defined as a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So, let's go through that again. A liability is a present obligation. Now, this obligation, as we discussed in the video above, can be contractual or it can be a constructive obligation. And it's the result of an obligating event, an event whereby there is no other exception but having to settle the liability. So a liability is a present obligation, contractual or constructive, of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. In many cases, this outflow is cash, but it can be any type of economic resource or any type of resource that produces economic benefits. Okay, that's enough on liabilities. What is a provision? Now, I'm going to do a separate video on provisions later, but just as a quick summary, as per IAS 37, a provision is a liability of uncertain timing or amount. Now, this is why it was important to understand the definition of a liability, because a liability is referenced in the definition of a provision. Okay, so a provision is a liability of uncertain timing or amount. So let's amalgamate the definition of a liability and a provision together. Therefore, a provision must be a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. However, the timing and amount of the outflow are uncertain. Okay, so that's the key last bit. The key last bit in defining a provision is the timing and amount of the outflow are uncertain. And a provision under IAS 37 is recognized if and only if it meets the definition that we've identified above. The payment is probable. So the economic outflow that's going to occur is probable. And we're going to go into the definition of what probable is, but it means it's more likely than not. And the amount, although uncertain, it can be estimated reliably. Okay? So that is the definition of what a provision is. Like I say, we will go into more detail in my future video that I'll release about provisions. But how does this all tie in with what a contingent liability is? Well, as per IAS 37, contingent liabilities are defined as liabilities that are not recognized because their existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events which are not wholly under the control of the entity. They're also known as liabilities that do not meet the recognition criteria of being a liability. Okay, let's dig a bit deeper. So, liabilities that are not recognized. Okay, so the first thing we can do is just isolate that and say what we know already are contingent liabilities are not recognized within the financial numbers. Let's leave that to one side. Why is this the case? It's because their existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly under the control of the entity. So whereby a provision identifies that there is uncertainty of the timing and amount of an economic outflow, a contingent liability calls into question the probability of an economic outflow even occurring. Okay, so there's a simple way to show this, and it's identifying the differences between probable, possible, and remote, which is where we can start defining actually what is a provision, what is a contingent liability, and what is nothing. So here's the definition of a provision again. I'm not going to go into it, but what can we take from that definition of a provision? Well, we know that there is a probable obligation. Why? Because there is an obligating event that has occurred due to past events. And an obligating event is one where there is no other option but to settle the outstanding obligation now or in the future. Remember that if a company can avoid paying for something in the future, then it can't be a present obligation. So, because we know that there is this obligating event and this requirement to settle, we're pretty sure that we owe something now or in the future. Okay, let's go on. So we know there's a probable obligation. Now, later on in the definition, it talks about an economic outflow. And it says there is an expectation that there will be an economic outflow from the entity of resources embodying economic benefits. Therefore, what it's saying is that it is likely that this economic outflow will occur, and therefore we can define that as being probable. And the last thing we know is that a provision can only be recognized if the amount of that outflow can be estimated reliably. Now, as per the definition, the timing and amount of the outflow are uncertain, but the provision is recognized when there is an amount that can be estimated reliably. So in all of these cases, the key word for a provision to be recognized is the word probable. And probable means more likely than not. So if you were to give it a percentage, it's over 50%. Now, let's look at that in comparison to a contingent liability. Why are they different? Well, let's look at that probable obligation. In the case of a contingent liability, you may be in a scenario where this obligation is only possible. Now, how do we know this? It's because in the definition it says the existence will only be confirmed by the occurrence or non-occurrence of one or more uncertain future events not wholly under the control of the entity. Therefore, there are still things to play out which may bring about an obligating event, or it may not. But essentially we don't know. And therefore, when we don't know, when it's less than 50% likely, it becomes a possible obligation, and it switches from being a provision to being a contingent liability. Another way that it may become a contingent liability and not a provision is if the economic outflow is only possible. So whereby the event may have occurred and there is an obligating event, but actually that obligating event doesn't give rise to a potential outflow of any economic resource or of any resource that embodies an economic benefit. Where it calls into question that money going out or that asset going out, then it can't meet the recognition of a provision. It meets the criteria of being a contingent liability. And the last case is whereby we cannot reliably estimate what the amount is, what the economic outflow is, whereby the estimate is unreliable. It cannot be recognized as a provision, it cannot be recognized in the financials, and therefore it's disclosed as a contingent liability. So the key in contingent liability is possible. The word possible. It may or may not happen. There's more than a remote chance that it will happen, but it is not likely. It is not going to be greater than 50%. Now, the only time where a liability isn't going to be a provision or a contingent liability or recognized elsewhere is where there is a remote possibility of economic outflow, where the possibility of an economic outflow is so low that we don't even consider it occurring. It's such very little chance, such slight chance of occurring. In that case, it's not recognized at all. Now, the consideration of whether something is possible or probable or remote requires judgment. That judgment needs to be documented properly. Okay, so you've done all of those tests and you think you have a contingent liability. What does this mean? Well, I've got an extract from ifrs.org of IAS 37, paragraph 27, which identifies what we do with contingent liabilities. So the first sentence is very key, very strong. An entity shall not recognize a contingent liability. So that means that it cannot be included within the financial information. However, the existence of a contingent liabilities should be disclosed in a separate note of the financial statements, so a wordy bit rather than within the core numbers itself. So what needs to be disclosed? Well, for this we have to go into paragraph 86 of IAS 37, and paragraph 86 says, unless the possibility of any outflow in settlement is remote, an entity shall disclose for each class of contingent liability at the end of its reporting period a brief description of the nature of the contingent liability and, where practicable, an estimate of its financial effect, an indication of the uncertainties relating to the amount or timing of any outflow, and the possibility of any reimbursement. So let's just focus in on the financial estimate. How is this done? Well, IAS 37 also defines that, where it says we need to have the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. And this is the best estimate of what we will rationally pay. Now, this is determined a lot by the judgment of management, but it's also supplemented by experience of similar transactions, reports from independent experts, etc. So I'll just give you a way where we get to a best estimate in some cases, because there are complications. Again, we'll go into more detail on this in the provisions note, but just as a way to kind of make us aware of how it works. We'll do the hardest bit first, which is where there's a large population, where there are different ranges of possibilities. what would we do? Well, in this case, we use something called the expected value model, and we use it if it's a large population or not. But essentially, you have to weigh up all of the possible outcomes by their associated probabilities, and where there's a range of probabilities, find the midpoint. So it's quite hard to explain it in words, but let's go through an example. A company produces tools, and they have the company are new and they've just started and they have no historic data. The tools themselves are covered by a warranty for 1 year. Now, for similar companies in the market, 80% of the products that they sell are not returned under warranty, they're fine. 15% are returned with minor defects under warranty, and 5% with major defects. Now, using industry information, cost of fixing minor defects for all these tools that they sell is around £100,000. And the cost of fixing major defects for all tools sold is around £200,000. So, what is the estimated liability provision, ignoring present value in this? So let's go through it step by step. 80% of the products are not returned under warranty. That means there's no cost involved in them. So we can estimate that at being £0, zero cost, times 80%, which is 0. Next, 15% of products may have minor defects under warranty. Now, the total cost of replacing all tools because of minor defects is £100,000. So what we have to do is take that 100,000, but prorate it to the population that is expected to have a minor defect, which is 15%. So we go £100,000 times 15%, which is £15,000. And lastly, we have 5% with major defects under warranty, which are likely. And the cost of fixing major defects for all tools is 200,000. So we have to prorate that 200,000 for the population that it actually is. So we do 200,000 times 5%. What's that? £10,000. So we have £0 plus £15,000 plus £10,000, which equals £25,000. And normally this would be a provision, because that's what we think we are expecting to pay, and we have got backup information to reliably estimate what that will be. But what happens if this company says, well, actually, we have a superior product to what's out there in the market, and we don't think we're going to have any returns, but we don't really know? Well, then the economic outflow becomes possible, but also the quantification of the economic outflow, the amount itself, it can't be reliably estimated. And therefore, then that becomes a contingent liability. So this is an example for a scenario where there is a large population and there are a range of results. It may be the case where it is just a population of 1. However, in the same scenario, there are possibilities of different outcomes. For example, if we are developing software for a client, and it's bespoke software, and there is a major fault in the software that we have developed, the most likely outcome is that when we repair it first time, that software will work and everything will be fine, and there'll be a cost of £10,000, let's say. However, you may need to provide for a larger amount than just the 10,000 if there is a chance, if there is a significant chance that it won't work on the first time using historic data, and that there may be other costs involved in it. And just remember as well, all provisions are measured before tax. Okay, so we've understood what best estimate and calculating best estimate means. What are the other bits that we need to focus on for the calculation of the financial effect. The financial effect needs to be taken to its present value. Now, we will cover how to calculate present value. I'm not going to go into it here, but essentially we need to calculate the present value of any of these financial effects. Next is any gains on expected disposal of assets as a result of any events that give rise to these provisions or contingent liabilities cannot be included within the total of the provision or the contingent liability. So this is usually for something like restructuring or sale of a business, that there is a potential gain on the disposal of these assets, but we can't include that in the value of the potential provision or in the disclosure for the contingent liability amount. We potentially have to risk adjust the number. Again, we'll go into risk adjustment later, but in most cases I've seen there is not a significant risk adjustment number because it's hard to determine and accurately describe what that number would be. How much should the risk adjustment be? And any reimbursements that are recognized must be virtually certain, but they cannot be recognized as either a provision or within contingent liability. They are separately recognized as an asset. And that virtually certain bit is key because it means that it meets the definition of being a contingent asset by being virtually certain. Okay, so that's everything on how to calculate the estimate of the financial effect. The other things that need to be disclosed are any indication of uncertainties relating to the amount of timing or any outflow. So this is giving information to the user which tells them, well, actually, we think it's this, but it could be this as well. It could be this because of a difference in this and this. It's just making it very clear to the user of the financial information. And then an indication of any possible reimbursement, be that through insurance contracts, be that from clients, whatever it is. Okay, so that is what needs to be disclosed. How does this normally look? Well, let's go to an example here. So what we have here is the disclosure from the annual report of 2019 for Lego. And this is one of their notes in the accounts, which is for contingent assets, liabilities, and other obligations. And in that you can see they've identified guarantees separately and other obligations separately, or contingent liabilities separately. And then that just gives part of that indication, but what is more important is the detail to the right, which gives an explanation of what all of this relates to. And that's the key bit. So you have to derive a number if you can, but the key is explaining what these types of obligations or contingent liabilities could be. And just to give a couple of examples of other things that normally crop up when it comes to contingent liabilities, litigation is probably the most famous one, whereby there is a potential for settlement, but we don't know fully yet if that's probable or not, and therefore an estimation is given of the settlement and of the legal status of those litigations. So you'll find, for example, you can go into the GSK annual reports and there's a massive section on legal disputes because they give rise to potential litigation and therefore a disclosure for contingent liabilities. Secondly, environmental cleanup costs. Again, these aren't probable, but a provision is identified in case at the end of the use of an area, especially for plants, that you may need to do an environmental cleanup, and therefore an estimate is kept for that. And then lastly, you come across guarantees, and these are usually guarantees for loans and for bank guarantees for commitments usually. And that's it. That's contingent liabilities in a nutshell. So I want to thank you again for watching the video. If you like the video, please press the like button, and please subscribe to my channel. And remember, you can follow me on Instagram. You can follow me on Facebook. I have a podcast on Podbean. And you can support me on Patreon. Please do support me. Any support I get will be used to make my video skills a lot better. You know, soon you may be able to even see this pretty face. But I want to thank you again. Take care, and I'll see you again for the next video.